Hello, everyone. Today on the Final Bar, I'll be talking with Mike Singleton of Invictus Research. We'll talk about some of the macro themes he's looking at, some of the defensive leadership that continues to be a question mark for these markets as the mega cap leaders, the stocks that have been leading the way higher, semiconductors and others, pulling back a bit today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is really designed to help investors better understand the world around them as investors, to focus on the message that price can provide back to us in terms of the interplay between supply and demand, between buyers and sellers, between optimism and pessimism, between euphoria and desperation. All of those things, I would argue, net out into the movements in the markets as best expressed through price action. And by analyzing price using tools like the technical indicators we feature, like price patterns and support and resistance levels and all those other things, we can make sense of the macro environment and focus on where the opportunities lie. Now, we've had the situation in 2023 year to date where it's been narrowly led, I think is an easy way to sort of summarize it, right? Those leading stocks have had a pretty incredible 2023. The S&P has had an okay 2023, but a lot of stocks have had a pretty rough 2023. So where are you at in terms of your experience as an investor? Let's try to get into some of those outperforming areas and lean away from some of those underperforming areas. Best way we can do that today is by starting with our market recap. Let's look at what happened in the markets today, what we learned about this environment from yesterday's close to today's close. The major average is down a little bit today with the S&P 500 closing around 4180. That's down 0.6% from yesterday's close. And Nasdaq Composite about the same, and the Dow a little bit less, down about 0.4%. So the S&P sort of trying yet again to eclipse that 4,200 level. That has been a big horizontal line on our chart coming from the February 2023 high. We keep trying to get above there, and I would argue trialing and failing to stay above that level of resistance. We're back below it today, again, closing around 4180. Mid caps and small caps both underperforming and having about double the down day that the S&P did. The small cap and mid cap indexes both down about 1.3 to 1.4%. The only green on the front page here is the VIX, right? Volatility popping a little bit higher, not by much to be honest with you, a little bit, and it's still what I would label loosely as low volatility, right? The VIX above 20 is more of a volatile market, more of a choppy market environment. Think of like a 2022 type of choppy downward phase. A low volatility environment, more like 2021. Nice, gentle uptrend, minimal drawdowns, low volatility. This is volatility-wise been a little more like 2021 than 2022. And again, you're seeing by the dominance of some of those mega cap names that the major indexes have certainly been moving to the upside with not a lot of trouble. Let's look at the fixed income markets here very briefly. For the most part, the yield curve coming down a bit. The 10-year yield, which we tend to focus on right around 364, and that's down a bit from yesterday's close. The long end as well, down to around 386. Bond prices, of course, moving higher, and the TLT was up about 0.9% to around 103. The dollar index, not too much of a change from yesterday. The dollar might be one of those important charts certainly to watch, arguably the most important one. So many things have a ripple effect relative that you can sort of trace back to the dollar. For what it's worth, you're getting a little bit of an upswing today, but not too much. Commodities a bit mixed, and it depends on what area of the commodity space you're looking at. Sort of the energy side, like crude oil, natural gas, all down 2 to 3% today. Precious metals a little more positive. Silver, the best performer out of this list of 8 commodity ETFs, with the SLV up 1.5%. Gold, a GLD up a little bit, 0.2% from yesterday's close. Looking at cryptocurrencies, a lot of the color red, which is not necessarily a good thing here. You can see crypto's down from about 0.5% down to 3 or so percent, depending on what area you're looking at. Bitcoin, where we tend to focus, Ether as well, both down about 2 to 2.5%. Bitcoin's still above 27,000, and Ether now has dipped just below 1,900, which is where we were yesterday at the close. In terms of sector leadership, you can see it was very much defense over offense today, and that's actually been fairly uncommon recently. We haven't seen defense leading too much recently. With today's guest, Mike Singleton, we'll talk a little bit, if we have time, about some of the defensive leadership trends. This is a theme that's come up quite a bit, right? It's sort of the growthy stuff, the technology, communication services that have been leading the way higher. Other things have been lagging behind. This is a fun show because for the first time in quite a few weeks, I can say the growthy big FANG sectors were not really the story. They're kind of in the middle of the road. The outperforming sectors today were the defensive things like utilities, healthcare, real estate, 1, 2, and 3. And utilities were up almost 1%. So not a huge up day, but a decent day in a sector that's been underperforming recently. At the bottom, we have energy down about 1.7%, followed by industrials down 1.4%, financials and materials both down just over 1%. Let's go to a chart of the S&P 500, our daily chart, just update where we're at relative to where we've been. This horizontal line right at 4,200, that's the level we've been talking about really since the February peak. Think about this first big upswing off of the October lows, sort of rallying to 4,100, the pullback in December to around 3,800, and then the push higher. And here in February, the market looks pretty strong in terms of the high-level indexes, to be sure. A lot of individual names, right? Look at the average consumer discretionary stock, probably making a new swing high in February, right? Most likely having a pretty good start to things. The chart like Etsy comes to mind, is doing really well up until that point. From there, it just went from good to bad very quickly for a lot of those markets. And if you think about breadth indicators, we'll look at one or two of those here in a moment. Think about the breadth conditions now in late May versus where they were here in early February. What's interesting is the S&P 500 is at the same level, right? We're at 4,200. This is where we rallied in February. We pulled back to retest the December lows at 3,800, then went right back up to retest the highs. And once again, for the last 3 weeks or so, we've been sort of testing 4,200, really came back from at the end of April. And from there, the month of May has been a consistent attempt to get above this resistance. Yesterday was an interesting day because you had sort of a bearish feel to the tape through the course of the day. The S&P opened higher and actually traded just slightly lower. And you can see that negativity, the sentiment from yesterday continuing on today, with some of those stocks giving back even further. And it's a lot of those leading names, charts like NVIDIA and others that are down today, sort of coming off of those overextended, arguably overextended levels. Let's look briefly at some measures of breadth if we could. I wanted to look at this one. This is the S&P. You can see the on a closing basis at the top, you can see we're at 4,200 back in February. We're back at to that same level here in late May. Look at how many stocks are above their 200-day moving average. Now, this is in the same index as the S&P 500, and this is the percent of S&P 500 members that are currently above their 200-day moving average. You can see the S&P itself, of course, above its 50-day, above its 200-day by a loose definition of trend. That's pretty decent uptrend to be above 2 moving averages as the S&P is currently sitting. Look at how 41% of the S&P members are currently above their 200-day. Back in early February, when we were last at 4,200, it was about 80%. So think about that. About 40% of the S&P 500, about 200 of the S&P 500 members used to be above the 200-day back in February, now below. This is Etsy and all the other Etsys of the world that were looking really good in February and now looking a lot less good. And what's interesting is, how can the market be doing this when the breadth is so negative? And it really comes back to how our indexes and how these ETFs are calculated, right? They are cap weighted, which means the biggest names, the biggest companies have the biggest weight. And it's not just a little weight. As we've mentioned many times here recently, the top 10% S&P 500 names have about the same weight as the bottom 400 S&P names right now. So it shows you what a significant impact each one of those has on the weight and the performance of the major indexes. That's how the breadth can be so negative. It's about 30% of the S&P members above their 50-day moving average. Back there in February, again, it was around 75%. So you've seen breadth deterioration. That means a lot of individual stocks have actually had a pretty tough quarter, while the S&P has been holding steady. And you compare the same chart to the NASDAQ, and you can see that the NASDAQ, of course, has had a pretty nice run to the upside. These are the QQQ, the NASDAQ 100. You can see here's the February peak. You can see we blew right through that, and we're continuing to push higher. So again, the strength in those mega cap growth stocks have really driven the NASDAQ higher, and certainly I would argue kept the major S&P 500 index elevated when a lot of stocks that are members of the S&P, and forget about mid caps and small caps, it's probably even worse, have been deteriorating quite a bit. Another way we can look at it is just looking at advanced decline data, and we can look at the McClellan oscillator. We could look at the raw advanced decline data. And if we look at the McClellan oscillator, you can see we dipped below zero the third week in April. We had a couple random days where we tried to get above zero, but overall it's been below zero. And this is basically a breadth indicator derived from the raw advanced decline data, just trying to track it overall as an oscillator. And these areas that are shaded red is when the oscillator is more negative, telling you that the advanced decline data is in a negative trend, essentially, is how I would describe that. So it's actually unusual that the S&P is up as much as it is, because if you look back at these red shaded areas, the conditions we're in right now usually are pretty bad for our benchmarks. It's a little different, again, because of the strength in those mega cap names, the AI trades, semiconductors, and others that have done quite well. Just to finish off our market recap, let's talk about some areas of the market pulling back a little bit here. Semiconductors, arguably, if you're looking for the group to sort of tell the story of the strength in the market in 2023, at times it's been things like home builders, maybe gold stocks at times, certainly not recently. You've seen a bit of a retrenchment there from the GDX and the GLD. But when we're looking at semiconductors, arguably the best, strongest place. Charts like NVIDIA have been top-ranked stocks, AMD, others. Probably half of the top 10 stocks or top 20 stocks in the our StockCharts scooter rankings in the large cap space are somehow related to the semiconductor space, either directly or indirectly. What happened is this was yesterday, we had this big move higher going into Tuesday's session. That was the gap higher at the open, but closing lower. This is when some of the individual stocks, this was one of our 3 and 3 charts yesterday, we saw some bearish candle patterns today, following through to the downside. So some of these names have actually had a pretty rough day. The SMH down 2.5%. The SMH was overbought until today at the close, coming out of that overbought region, which often means we're sort of in pullback mode. And I'm wondering where the semiconductor index and the ETFs here could pull back to if we see further deterioration into this weekend. Let's take a quick commercial break. We'll be back with Mike Singleton of Invictus Research. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. I'm going to bring on Mike Singleton, today's guest, here in a few moments. But before we do that, just wanted to give an announcement or two. First off, we welcome your questions. We welcome your feedback. And our mailbag is fueled from questions from all of you. Give us an email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts TV YouTube channel. We'd love to hear from you. Hope to answer your question live on the air. Upcoming guests tomorrow on June 1st, Thursday, we have Leslie Juflas. Leslie is here locally in the Seattle area. She'll be in our Redmond studio tomorrow. It'll be a lot of fun to sit down with her in person, talk about short-term patterns and movements that we've seen in the major averages. On Friday, I will be off, and my friend Jay Woods will be hosting remotely from New York. He's the chief strategist at Freedom Capital Markets. Should be a lot of fun. Jay's a smart guy with a lot of great experience on the floor of the New York Stock Exchange. We'll see what charts and themes are top of mind for him. I want to bring on today's guest, Mike Singleton. Mike's the senior analyst and principal at Invictus Research, coming to us from Maryland, the home of crab cakes, football, and Invictus Research. Mike, it's great to see you. Welcome to the show.
Thanks for having me, Dave. Love the show.
I appreciate it. It was awesome to meet you at the CMT Symposium in New York not too long ago. I'm super thrilled to have you on the show here and get some of your expertise in front of our audience. You know, when we're talking about the overall environment here, as we've sort of progressed through the debt ceiling, which hopefully is kind of behind us, we have all these other macro narratives to debate. We're now coming up to yet another Fed meeting. As you are thinking between now and that upcoming meeting and the overall trajectory of what we've seen from rates, where is your head at in terms of expectations for the upcoming Fed meeting?
So in the beginning of May, at the last Fed meeting, the way Chair Powell left it was the FOMC is no longer expecting to hike rates again, but they're going to be data dependent. The data for May came in a little bit hotter than expected. namely the data that I would be focused on myself is the core inflation number.
Mm.
It's been run rating at about 5% annualized for a while now. It didn't show any signs of slowing down. The labor market data remains very strong. And for that reason, I think that a 25 basis point hike on the 14th is likely at this point. Now, that said, would I be positioning my portfolio for higher rates at this point in the hiking cycle, in the policy cycle? I'd say probably not. While the economy has clearly remained resilient, or more resilient than a lot of people expected anyway, in my opinion, it's pretty clear we're toward the end of this hiking cycle, not toward the beginning. And unless you have a very short time horizon, I would not be making a long-term bet on higher rates right now. That said, our policy outlook at Invictus is neutral, so that's not a very fun answer, but that's the most honest answer we can give right now.
I'll take honest over fun anytime, so I appreciate your honesty and being straightforward about it, Mike. What should we make of the FedWatch tool? I'm sure you're familiar with, where you can see how the futures market is pricing in potential changes and upcoming Fed decisions. About a week and a half ago, maybe 2 weeks ago, it was likely, based on that futures pricing, that the Fed would remain steady. Now, all of a sudden, the market pricing in a further rate hike. What does that shift in sentiment tell you about the state of investors and the state of the markets here?
So first of all, it's a great tool, and it's free, and I think every investor should be using it if they're not. Like I said, I think it's hard to take away anything super actionable from it. If the economy remains quote unquote resilient, we could get another 25, maybe 50 basis points worth of hikes. But if we do go into a recession, we're going to be looking at 200 basis points of cuts, 300 basis points of cuts. That wouldn't be out of the ordinary at all through a recession. It might not happen as quickly this cycle for reasons that we can get into later if you'd like, but that's not exactly an asymmetric setup, which is why I say I don't think it makes sense to get long higher rates here.
No, it's really, really helpful. I appreciate it, Mike. I want to get to some of the charts that you brought with us, particularly to pivot into the commodity space. You know, in a recent note, we're talking a lot about just inflation and expectations and sort of setting the stage for where we're at right now. The chart I wanted to show is looking at the copper to gold ratio. Why is this ratio important, and what is it telling us about the conditions here?
So we love looking at the ratio of copper to gold and oil to gold at Invictus. And the reason is that both of these ratios tend to track the growth cycle pretty closely over time. You can see on the slide here, you can see that the commodities market pretty obviously priced in the Trump bump, growth rolling over in 2018, COVID, the reopening, and now what we're calling sort of the post-COVID, post-stimulus hangover. So why do these ratios work? Maybe it's obvious, maybe it's not, but copper and oil are both highly pro-cyclical reflationary assets that essentially trade right atop the growth cycle. When economic growth is accelerating, that usually means more industrial demand for copper and for oil, and that puts upward pressure on prices, and gold in the denominator tends to be more defensive. And so that's why you get that price behavior that tracks the growth cycle so well. The fact that both of these ratios are making or are very near cycle lows is an indication that the global economy is actually not all that healthy. And so it's one of the reasons that, again, we're not super excited to get long higher rates here, because if this ratio is telling us that there's going to be a recession or a significant contraction in economic growth, and that's what history tells us, that's how history tells us we should interpret these ratios, it's a time for playing defense. And eventually that will mean probably buying bonds.
It's fascinating. This next chart, getting to that relationship between these ratios and interest rates. What does it mean with copper gold, oil gold at cyclical lows relative to the interest rate environment here?
So over time, these ratios and the 10-year Treasury yield tend to track each other. That's not happening right now because these ratios are near cycle lows and the 10-year is sort of inflecting upward. Right now, the 10-year is really trading on sort of technical liquidity dynamics that are interesting to get into. I'll try and be succinct. But anyway, when the Treasury general account draws down, that puts downward pressure on rates. And when the Fed expands its balance sheet, that also puts downward pressure on rates. And so we've seen the Treasury general account draw down with the debt ceiling debacle. We saw the Fed expand its balance sheet as a result of the regional banking crisis. And rates kind of went lower as a result, which has supported long duration assets like the 10-year note or long-term government bonds or the NASDAQ and AI stocks and Bitcoin. And so it creates this sort of irony that the two big risks that investors have been talking about through the new year, right, the debt ceiling the regional banking crisis have actually been significant liquidity tailwinds for the markets. And as those things resolve, it's going to put upward pressure on rates, and I think downward pressure on long duration assets, although we haven't really seen that in the stock market just yet.
It's interesting, your next chart's dealing with household equity exposure, which I think is such a fascinating chart. I'd love to spend a minute or two on this one. What does this tell us about the condition of, I guess, individual investors and their exposure to the markets here?
Sure. So this is from the Fed flow of funds data. I didn't do a great job labeling it, but really what it represents is the percent of financial assets that households own in terms of stocks and equity mutual funds. And right now it's at 35.6%. That represents a 95th percentile reading. In other words, households have only owned more stocks as a percent of their financial assets 5% of the time going back to 1945. And the reason that we care about this at Invictus, and this is not shown in the slide, but it tends to correlate very well with real returns over the coming 10 years, right? So if you ran a regression, what it would imply is that real returns over the next 10 years, so through 2033, we should expect low single-digit real returns, call it 2 to 3%. And so the sort of pithy one-liner we can give at Invictus is that right now stocks are over-owned and overvalued if you have a 10-year time horizon, which candidly most people don't. But even if you don't, it's good to keep that in the back of your mind.
Yeah, and it certainly gives you a sense of the headwinds, or probably, I guess, more headwinds than tailwinds we may have for risk assets going forward. You mentioned Bitcoin. I'd love to bring that into here. Cryptocurrencies, I feel like, is an area of the financial markets where people are still trying to get their head around what it means, and are they a risk asset? Are they not a risk asset? Are they currency, or are they not a currency? When you're looking at Bitcoin, what information can you draw out of the performance of Bitcoin, particularly the rotation higher that we've seen in 2023?
So what I would say is that there is no financial instrument more sensitive to liquidity conditions than Bitcoin. So when there is the faintest whiff of slightly easier Fed policy in the air, Bitcoin is going to catch that and it's going to trade higher on it. And likewise, when there's when the market starts to discount that the Fed is going to tighten or maybe not be as easy as expected, Bitcoin is going to basically decline on those expectations. And you can see bank reserves tend to correlate very closely with the price of Bitcoin. You can see bank reserves have been turning up in 2023 for the reasons that I just went over with the TGA and the regional banking crisis. But as bank reserves start to normalize, as QT recommences, as the balance sheet runoff recommences, that'll put downward pressure on reserves, downward pressure on Bitcoin, and downward pressure on all long duration assets. And I want to caveat something I said earlier. These technical dynamics put upward pressure on the 10-year yield. But over time, the 10-year yield will probably trade lower as a part of the flight to safety trade. So just so I'm clear, short-term higher, intermediate term lower for rates.
Interesting. Yeah, and you mentioned that about a safety, a flight to safety into bonds, which makes a ton of sense. One of the issues of many that we've had here recently is sort of the defensive, the performance of sort of the mega cap leadership versus defense, and you highlighted with some of these charts about how a lot of the defensive ratios have really rotated to new lows here for the last couple months. What does that movement in defensives mean, and what would you be looking for some sort of change of character in these markets?
Right. So what's been going on with defensive equity exposure is relative. Staples is a very good example. Well, they had a great 2022. I think if you were going to own stocks in 2022, consumer staples, utilities, healthcare were very good bets. Besides energy, they were probably the place to be. Since the new year, since 2023, that's not been the case, and you can see that staples are hitting a multi-month relative low relative to the S&P 500. So I think that there are a lot of investors, specifically technicians, who look at something like this and they're like, wow, this is risk on, this is bullish, this is price action characteristic with bull markets, not bear markets. And all that's true, but I think it's a little bit misleading, because one of the reasons that the S&P 500 is doing really well is it's like you talked about earlier, right? There's very concentrated leadership at the top. The S&P 500 is very growth heavy. It's very tech heavy. It's got a lot of exposure to assets that are sensitive to Fed policy and some of these liquidity dynamics that I've been talking about. So while I don't want to act like this chart isn't happening or that it doesn't matter, it's maybe a little bit misleading in terms of the fundamentals that are driving it. And so one adjustment that you can make is looking at staples or healthcare or whatever else divided by the S&P 500 X technology. And what you would find if you looked at that chart is that staples are not necessarily breaking to a new relative low. It doesn't look great. It doesn't look like a great chart, an obvious buy on a technical basis, but it's not, it doesn't look like a breakdown necessarily. It's a more bullish looking chart. And I think you also have to consider too that a lot of the big tech names that people colloquially call big tech are also not in the technology sector, technically, according to GICS. They're out there in communications or just consumer discretionary or whatever else. But if you look at staples relative ex big tech, it presents a different picture than just looking at it relative the way a lot of technicians and other analysts do.
I feel like there's technology and then there's technology in air quotes, where many stocks could be described that way probably in 2023. Mike, I feel like every point we made could be a whole hour of a discussion. I hope this isn't the last time we have you on the show, and I appreciate you joining us today.
Thanks for having me.
That's Mike Singleton. Mike's the senior analyst and principal at Invictus Research, coming to us from Annapolis, Maryland. It is such a pleasure to get to know Mike a little bit. We sat next to each other at a dinner in New York not too long ago for the CMT symposium, and I just so enjoyed picking his brain about some of these macro themes. I appreciate that opportunity to illustrate some of those key big picture ideas. And again, when you hear how he's talking about the defensive ratios, think about the next level down, right? The construction of those ETFs, the weightings, and what those ratios actually represent. Beautiful take there, and some really interesting points by Mike Singleton at Invictus Research. We have to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Going to look at bond prices. I like Mike Singleton's comment about the looking for some sort of flight to safety. When you look at the TLT, which is one of the ways we just like to track general movements around bond prices, you can see we're coming out of the lower end of the range that we've been in for the last 6 months or so. After the TLT bottomed out in October, right about where stocks did, kind of rallied up to a peak in December, and from there it settled into this general range over the last 6 months. The RSI, the measure of price momentum, really illustrates a range-bound market, I think, better than anything. On the rallies within this range, the RSI has rarely gotten above 60. On the pullbacks within the range, the RSI has rarely gotten below 40. That is the definition of a neutral trend according to a momentum indicator like RSI. Look for this price to break out of that range, and look for the momentum to break out as well. That's something we've certainly not seen, and I think a flight to safety trade certainly would start to be reflected in something like the TLT. We're not quite seeing it yet, but we are seeing a bounce off of the lows. Chart number 2, the semiconductor ETF. I'm looking at the unadjusted raw data just to look at the longer term trend, not including things like dividends, but just looking at the actual price behavior. What concerns me about charts like Apple, about charts like Nvidia, about things like the SMH and many other things that have been working in a big way over the last 6 months is a lot of them are trading up to significant resistance. A lot of these things have gotten back to their all-time highs from the end of 2021, beginning of 2022. And just because we're getting to a new high is not on its own a reason to be selling anything. Let's make that clear. However, you need to be aware of where the resistance and the support levels are. One of the reasons why this show is called The Final Bar, besides the sort of musical connotation to that title, it's because when I was teaching technical analysis, I would always say start with the final bar and look to the left and see where we're at relative to where we've been. We're approaching all-time highs, and I would be expecting at least some sort of resistance from that level. Speaking of resistance, Tesla having a decent week here, getting above its 200-day moving average, closing above the 200-day with a nice rally into the close for the first time since September of last year. What's interesting is we're nearing the 220 point, which is the peak from February. It's also the first big Fibonacci retracement level off of the lows in January. Tesla can get above 220 and go much further, but to get to 320, it first has to get through 220. So let's focus on how we do relative to that first level of resistance. Folks, that's a wrap for this show. I want to thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Mike Singleton of Invictus Research joining us from Annapolis, Maryland. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.